A few years ago, I picked up some knowledge from a trader, and his name was Mark Braun. Now, Mark passed away a while ago, and we're not going to diminish his life outside of trading at all, but our community, our trading community, we really lost a really good educator, whether you agreed with how he traded or not. He liked the CCI indicator, the Commodity Channel Index, and that is a momentum-based indicator that falls under the oscillator classification. Many of you have said that you like the videos that we put together about trading indicators, so we're going to talk about the CCI in this one. And the CCI, it oscillates between several levels, and they include the plus and minus 100, the zero line, and the plus and minus 200. And these levels are often used as overbought and oversold levels. The 100 would be considered overbought as an example, and a move below the 100, so minus 100, would be used as an oversold condition. And from there, traders expect a retrace in price, and we often look for reversal trades. But Donald Lambert, he designed the indicator. He actually used the extreme readings of plus 100 or minus 100 as signs of a strong or a weak market. He would then look to establish a trading position in the direction of the trend. So while oversold and overbought levels are not the intention of the CCI, a lot of traders use those market states as the basis for their trading strategy. And like other trading indicators, the CCI has a few variables that you can change depending on the strategy that you're using. The look back period, it's usually 14 and 20, and that's the number of periods prior to the current period that the indicator will use in the calculation. And later on, we're going to use the 50 as well. The levels, and these are usually the plus 100, the minus 200, the zero levels. We already talked about these. And they can be changed depending on the backtesting results of the trader. And the price source. And a lot of indicators use the closing price, but the CCI uses the average price of three prices. The high plus the low plus the close divided by 3. And that's the calculation. So from there, the calculation of the CCI, in this example using a 14 period setting, would be this. And the typical price setting is high plus low plus close divided by 3. And this calculation, the one that includes the 0.015, that is the mean deviation. And that is designed to ensure that the majority of the time, the levels of plus 100 and minus 100 will contain the price. Now this indicator can be considered a detrended moving average oscillator. So to explain what that means, and to give you a possible aha moment, let's take a look at a chart. And here I plotted a 20 period simple moving average on price and the CCI 20 in the lower pane. So a few things you should notice to understand how the CCI works. The green arrow shows where the CCI is crossing the zero line. So look at price crossing or hovering near the zero line. The green arrows are extreme price moves. And I want you to notice how far and fast price pulls away from the SMA and the CCI reading. What you may want to consider is that the CCI is measuring how fast or far price moves away from an average price. So the further the price moves away, the faster price moves away. That's how we measure momentum. Price that's hugging a moving average, it's not showing momentum. Price pulling from an average price is showing momentum. The CCI measures via the levels the strength of the momentum in the market. So in essence, we are looking at the CCI as a means to gauge, to see where price is in relation to a moving average. And from there, we can determine if a market has momentum and if it is worthy to trade. So the first trading strategy I want to talk about is trading a trend direction change. And for that, we're going to use the CCI 50, and we're going to pay attention to the zero level. The CCI 14, we're going to pay attention to the plus 100 and minus 100 levels. 34 EMA. Now, this is a 15-minute chart of crude oil futures, which is a preferred day trading market actually at Netpicks. And here are the rules for this strategy. Number one, for a long trade, price has to cross and close above the 34 EMA, and the 50 CCI must cross the zero line. We want to check the 14 CCI to ensure it is also above the zero line. And then you could enter at the close or the break of highs. For short trades, price has to cross and close below the 34 EMA, and the 50 CCI must have crossed below zero. And for number 4, the CCI 14 must already be on the downside of the zero line. And there are a few ways to place a stop loss, and a lot of traders will probably choose to place their stop a few ticks, pips, points, depending on your market, below the candlestick that sets up the trade entry for a long. Profit targets can be a multiple of your risk, or you may choose to trail and scale out at certain chart points. Traders may also decide to exit when the indicator turns down, and from a long trade, from the 100 levels. So if you find price moving with momentum and the CCI not looking back after crossing the 100 levels, this may be a time to execute your trailing stops. Now, the other strategy is trading the trend change pullback. So this is more of a conservative approach, and it's going to require some type of pullback in price or the CCI. And the reason is that trend changes in general can be pretty messy, or they can fail. And with the pullback method, we're going to use a standard market mechanic, which is a pullback in price. And this here is a 4-hour chart of a Forex pair, and it's going to show both long and shorts. And I'm also going to show the original trades using the trend change method and the pullback style. And number 1, this is our standard trend change strategy, and we did get a push to the upside, but price reversed and the 50 CCI dropped below the zero level. And number 2, this is another trend change, and although the zero line is not on the 14 CCI, it's crossed. And this trade does sit through 16 hours of chop. And number 3, this is the first pullback trade, and this can be used as an add-on or a standalone entry. So the 50 CCI has bounced off the plus 100 level or the zero level. That's fine as well. And price is stalled near the 34 EMA. Your trade entry can be when the 14 CCI crosses back over the zero line, which it does in this example. And number 4, this is the standard entry. Number 5, the 50 is bouncing off the minus 100 line zone. The 14 CCI is bouncing off the zero line, and price is bouncing off the 34 EMA. Number 6, the CCI 50, it stays below the zero line. The 14 CCI crosses up and over the plus 75 line, and you can enter when the 14 CCI crosses back under the zero line. So what we're looking for in a pullback trade are a few things. We have to see the 50 CCI stay on the same side of the zero line. So if it crosses, we have to revert back to the original trend change rules. The 50 can bounce off of the 100 line or the zero line once our price direction is established. And that's for a long trade. We want to reverse that for shorts. The 14 can bounce over the zero line to the opposite 75 level, the plus or minus, and cross back over the zero is the trigger. So if the 50 stays above the plus 100 for a long trade, the 14 CCI crossing under the plus 100 line and back again is another trigger. And the stops and the profit targets are going to be the same for all these other trades as well. So all we're doing really is allowing the trend to change, the trend to evolve, and trading the first pullback in the trend. So why do we want to do that? Well, if a trend is not going to establish, the first place it's going to fail is the first pullback, where price fails to make a new high or low depending on the direction of the trend. So keep in mind, while we can use the CCI for trade triggers, a lot of traders who understand price action will want to use the signs the market is given. And using price action with the CCI, that can form the basis of a profitable trading strategy. With price action, we're looking to get into a position earlier than a lagging indicator like the CCI will get us into, and that can allow us to be in a position before momentum picks up. And this is the same chart as the last example, and I focused on 2 areas. On the left, we can see upside momentum stalling as we pull back into the EMA. And the candlestick that's noted, that is an inside candlestick, which means volatility compression. And if you were to drop to a lower time frame, you would see a trading range. Traders can position inside the range or set an order to short, in this example, if or when price breaks out of the bottom of the range. And in doing so, in this example, you participated fully in the momentum push down. So on the second example, we can see the range forming. And I want you to note also, price based near resistance. And that's bullish over a large sample of trades. Price failed to break out of the short-term range. Price then wipes out the previous 7 days of price action. The inside bar is volatility compression, and you would see a range on the lower time frame. And since we're bearish, we would set a sell stop order at the bottom of the range. As with any trading strategy, I like to use price action alongside an indicator for any decision I'm going to make. And you can also use various forms of technical analysis, including trendline breaks on the bull flags and the bear flags that form in the pullbacks for your trade entry. The CCI trading strategy, this is for continuation trades. So while the word continuation could apply to the trend change pullback strategy, we have to focus on the intention behind the trade. In the continuation strategy, we are looking to take advantage of a trend that is maturing and position in that trend. So we want the instrument to have changed trend and gone through the first pullback. The 50 CCI has to stay on the right side of the zero line. The 14 period CCI must dip below the minus 75. That's for a long trade. We enter when the CCI crosses the zero line. This here is a stock chart of Nike, and it is the 15-minute chart for day traders. And on this chart, we've had the trend change already happen, as well as the first pullback after that change. At number 1, the 14 CCI has dipped below the minus 75 line, and upon crossing the zero line, you enter the long. Once the CCI drops back under the zero line, we can exit. And this chart has a $1.46 a share in profit. Number 3, the 50 CCI is still on the long side. The 14 CCI crosses back over the zero line, trade entry. Number 4, the 14 period CCI drops below the zero, and we exit for a $1.45 per share profit. And what's interesting to note, that the CCI crossing zero would have you exiting prior to that gap down in price. So let's wrap it up. I think these CCI trading strategies are worth your time to backtest and show yourself the potential of using this indicator. Experiment with different stop loss locations as well as ways to maximize the profit on each trade. Trading multiple contracts, that can aid you in scaling partial positions while leaving enough on the table if and when price begins to run away. And as with all trading strategies, you have to ensure you make a trading plan and be consistent in following it. You're going to win. You're going to lose. So you just accept the losses. Just keep executing that trade plan. So do me a favor. Can you subscribe to our channel? Give me a thumbs up on this video. And on the next screen here, I'm going to have a free PDF you can download about candlestick reversals. Thanks for watching.